Hello, and this time on the Mortgage and Protection Podcast, we have Paul joining us from Henchurch Lane to chat about using retained profits for a mortgage. It's great to chat with you as always, Paul. How's it all going?
Very well, thank you. Looking forward to this one.
Yes, yeah, definitely. Shall we get straight into the questions then?
Let's go.
Okay, so of course we'll start with this one. What is a retained profit mortgage and how does it work? Is this a specific product?
Um, I wouldn't say it's a specific product. So retained profit mortgage is really designed for company directors. So if you've got a limited company, a lot of the times if people have got limited companies, they might not take all of the earnings, all of the net profit as their salary and their dividends, or what people might refer to as drawings.
Mm.
So the lender, in this instance, if we can ask for a lender that looks at retained profits, they're going to be looking at how much money is left in the business, how much is in capital reserves, and they can actually look to implement that within their affordability, which is going to reflect your borrowing power or your potential.
Mm.
So it suits some people that leave profits in their business rather than drawing them on their personal income.
Mm.
Not everybody does it, but I'm sure we'll come to those sorts of questions later on. So it's not a specific mortgage product, but it is with specific lenders that would actually entertain it as adding it to the affordability.
Okay, which explains it there. Hopefully that's making sense. And this question actually follows on from that. You've touched on a few of these points. So, am I eligible if I keep profits in my business instead of drawing them as income?
Yeah, so that's exactly who this type of mortgage approach is for.
Mm.
If you're a limited company director, you left money in the business rather than paying tax on it to draw it down as your personal income. Some lenders will look to use those profits when assessing your income and your affordability. So that's exactly what it's for.
Okay, brilliant. And again, you're ahead of the game here. So we'll look at this question. How do lenders assess retained profits when calculating affordability? You touched on it there.
Okay. So yeah, to give you a little bit more of an explanation on that then, instead of looking at your personal salary and dividends, so a lot of people as a director, they'll pay themselves a salary plus they'll top that up with dividends.
Mm.
And a lot of lenders will look to use those two added together to assess your affordability. But if you look for a retained profit mortgage, then they're going to be looking at this money that's left in the business as well as your drawings. And it's
Mm.
going to give them the option or the opportunity then to increase your borrowing potential.
Okay, so thank you for explaining that further. Let's move on now to this question. So, people would like to know, do I need an accountant's certificate to prove retained profits?
I would say most of the time, yes. So lenders are usually going to want your accounts to be signed off. If you're a limited company, they're realistically going to need to be signed off by an accountant that's got certain qualifications. So
Mm.
much more difficult to get it signed off as a limited company if you've done your own accounts. So I would look to instruct a decent accountant with the right qualifications.
Mm.
And that's then a further request from some providers, some
Mhm.
lenders to get, I would say, maybe a bigger picture than what the figures give them. So they're looking at maybe projections or explanations as to why that money is still there and why it's not been taken. So a lot of the times it would come with a request for an accountant certificate. Yeah.
Okay, so something to be aware of there then. Let's move on to this question. So, will all lenders accept retained profits for mortgages?
No. So only a handful will actually look to implement any kind of retained profits within the business.
Mm.
Most lenders are going to stick to that salary and dividend approach that we mentioned earlier on. And that's a good reason why I would say if you're looking at anything like that from a self-employed or limited company perspective, it's a good idea to employ a specialist broker. So straight away, I could probably list a handful of lenders that I know would fit the bill if anybody's looking to approach it with a retained profit perspective.
Mm. Okay, brilliant. There we go. And speaking of salary and dividends, I'm not sure how much more you've got to add here, but can retained profits be used alongside salary and dividends for affordability?
Yeah, so there is a bit to add here. So a lot of people might think because they're looking at retained profits, then the lenders would look at the net profit aspect of their business. But
Mm,
there are people out there that would look at your salary and dividends and combine that then with the retained profits in the business. It might not necessarily give you as much as it would if a lender looked at the net profit and the retained profit.
mm.
But it's another approach, and each lender will have their criteria in the background that determines which way they're going to do that.
Right, okay. So let's move on again. Then we're getting through these questions now. How many years of business accounts do I need to show?
So most lenders are going to ask for 2 years when it comes to any kind of self-employment. A few might consider one, but because you're looking at a fewer list of lenders straight away, then you're adding in the need to look at retained profits.
Mm,
It might leave you with quite a small pool of lenders at the end of that, which again is more reason to make sure you're looking, at an independent bit of advice there. But I would say you're in a strong position with two. Some
mm,
might even ask for three, but you can achieve it with one. That's probably the best way to give you a sort of
mm.
conclusion to that question.
Okay, so there we go. Hopefully that's useful and reassuring as well. Now, do lenders look at net profit, gross profit, or both?
So they're more interested in the net profit. That's really the bit after expenses, after taxes. That's what realistically you could draw down on as a director with a limited company. So that's really what they're going to be looking to assess your affordability with, and combining that with your expenditure as well to come up with, an overall kind of maximum loan that's going to make sense for you that's affordable.
Hmm. Yes, okay. Right, so we've got three questions left now. So, how does using retained profits affect the loan to value or LTV I can borrow?
Okay, so using retained profits doesn't change the loan to value limits. Loan to value limits will be set by other things. Those are usually the same across the board, regardless of whether or not it's retained profits or not. Obviously, you're working with a smaller pool of lenders to begin with,
Hmm.
but it's not out of the question to get up to 95% on a retained profit approach looking at a mortgage. Although, if you do look at the retained profits, and that is something that the lender's willing to add in,
Hmm.
I would say that's going to have a positive impact on the maximum loan size. So allowing you to borrow more at 95%, if that makes sense.
Yes, definitely. Okay, well, there we go. That explains that. So, are the interest rates or fees higher for retained profit mortgages compared to standard self employed mortgages?
Not usually, no. So rates are broadly going to be the same, even as standard employed mortgages.
Mm,
The difference is, as touched on earlier on, you're working with a smaller pool of lenders. Therefore, you might not necessarily be able to get the most competitive rate in the market because that might be someone who doesn't look at retained profit mortgages. So
mm.
that's what you need to be aware of. Um, that's really all I can say on that point. Yeah.
Okay, well, hopefully that explains that there for anyone listening to this or watching this. And now, just lastly, we always end on this note, don't we? And you've demonstrated this already, but how can a mortgage broker help here? Anything else you'd like to add?
Yeah, so I nearly elaborated on that previous question, on the penultimate question.
Mm,
It's a good example. However, I knew this question was coming. So,
yeah.
in this instance, you could look for a retained profit mortgage, and you've limited that pool of lenders and you make your choice based on that. The
Mm,
reason that you would use a broker is because in this particular example, it's not out of the question that actually using a lender that doesn't include your retained profits, but offers a larger multiple of your overall income from an affordability point of view, could actually result in a higher loan size and have a much more competitive rate than the retained profit lender. So it's not always as simple as this is my criteria. I need to go to a lender to make sure I can tick all those boxes. It's
mm,
a case of taking everything into account and coming up with the best suited option that you can achieve,
mm,
including things like rates, affordability, timescales for lenders, how difficult it's going to be for you to get the application over the line and things like that. So
mm,
it's really a bigger picture. And you just can't, I don't think, really see that unless you're using a specialist within that field. So I
mm.
think that's how I would answer that last question for you, Tessa.
Yeah, a good note to end on there. Lots of factors involved, it sounds like. But thank you ever so much for that. Hopefully, that has proved useful to anyone listening to this, watching this video. And Paul, I'm sure we'll be back with another episode very soon.
I look forward to it. Thank you, Tessa.
Take care. Bye bye.